Well, Tavi Costa joins us today, a macro strategist, CEO of Azuria Capital, former Crescat Capital partner. Many know him for his take on undervalued assets and where it should sit in portfolios. Tavi, welcome.
Thanks for having me. Looking forward to this conversation.
Well, look, I read your note this morning on what you're calling the rebirth of mining. Let's start there. And you make the case that we're not near a peak, but at the very beginning of a structural repricing, right? I want to zone in on that. Gold is already near record levels. Mining stocks have doubled in some cases. Capital is flowing back in. So help me understand, if this is only the awareness phase, what does access actually look like? I mean, what specific metrics tells you we're early, not just telling ourselves we are?
Access will look like abundant supply of metals. Access will look like a lot of discoveries in the market. Access will look like a lot of CapEx being spent across all companies, particularly relative to metal prices or gold prices, which is your inflation adjustment, which currently is at record lows in terms of spending. Access will look like exploration budgets at all-time highs, not four-year lows. And also, I should say, an M&A cycle that you've never seen before with major companies acquiring small companies. We haven't seen any of that, right? Mm-hmm. So all we're seeing is metal prices going up, a bunch of institutions being caught off guard and starting to have to allocate or show their clients that they have some level of exposure to mining. They don't know what they're doing. They're just buying the major companies. It drove the major companies higher. The inefficiency of the market with a lot of high quality assets still completely mispriced is still an opportunity in my view. And we're far, far away from what I think it's going to be a peak of the cycle here. So yeah, you can't really change, decades of neglection in an industry with 2 years of good performance. That's not how that works. And so, yeah, we're still early in the cycle for mining, in my view.
Mm. And you compare today's debt levels to the 1940s, Tavi, where, when much of the larger share of US debt was backed by gold, implying far higher gold prices. But in a fully fiat system with no convertibility, what actually forces gold to reprice toward that balance sheet math?
I think it's a question of investors losing faith on the currency itself, and especially causing what we're seeing right now with a fiscal authority that is looking to accumulate critical metals in its balance sheet, having to invest in mining companies to have security of resources in the future. All these things, and I know people are not seeing it as that way, but these are ways of accumulating minerals in your balance sheet over time. We're seeing a big shift away from the relevance of the Fed balance sheet into the fiscal balance sheet, which is going to be probably the biggest transition we're going to see in terms of policies ahead. And, I think that's just the research to show us that back in the 1940s, the debt itself was basically backed by about 50% of gold reserves. And today we're at 3%. So, is that right? I mean, am I saying that we're going to go back to 50? No. Am I saying that 3 is too low? Yes. I mean, it's way too low. I mean, there has to be something in between. That's all I'm saying. Yep. And if there's something in between, it's multiples of the price of today. And that's, to me, that's not the peak of the cycle. It's still the beginning, or call it the third inning of a cycle that we have here for metals and mining. Gold prices, majority of the analysis we're seeing out there is nominal analysis, not relative to how much credit we have in the system. I mean, just think about all the wealth we have in the world today. Gold is not even 5% of the overall wealth in the world. And so we haven't seen anything yet. There's going to be, in my view, a lot of repricing in the metals environment.
Yeah. Well, look, let's shine the spotlight on silver miners, right? Silver miners have a history of dilution, operational risk, and poor capital discipline. Why isn't this valuation gap structural rather than the market simply pricing that risk correctly?
Yeah, it could be. I mean, there's always, every time you get to a very extreme situation of gold to silver ratio that doesn't want to return. I mean, how many times have we heard that was a structural and ended up not being a structural? Or Right now, we're seeing the gold to oil ratio. How many times people are saying it's going to be structural and it's never structural. It's going to come back. I mean, when you're playing with extremes in history, and you're paying the price of making that view being very expensive. In this case, to take the view that silver miners are actually operationally do have a leverage over silver and will likely be generating a lot of cash flow in the future. I mean, look, we own a mine at St. Cristobal, and I don't think that's unique to us. I've said this in other podcasts before. I mean, our cost is around $15 an ounce. Where's silver prices right now? $70 an ounce. Our margins are better than Google's margins. Why is our valuation not as good as Google's valuations? Well, because a lot of people think that metal prices are unsustainable at these prices. Well, what if it's higher? What if in 5 years from now, metal prices are actually higher, not lower? And I think there's a lot of misconception and misunderstanding of what could happen here in this industry. And I would argue that this industry has never been more relevant in regards to the structural demand that we're seeing from AI and solar panels and what we're seeing with electrification that needs to be all rebuilt in most places in the world, the deglobalization trends, the central banks having to acquire metals. I don't know. I think all these things are pointing to a real structural demand with supply that we all know it's very constrained. So yeah, dilution is an issue. It's always going to be an issue. That reminds me of folks that, when you say you should invest in emerging markets, yep, when they start saying that it's a very corrupt place. Yes, it is corrupt and it's not going to change. I mean, that's not the game here. We're not trying to change the world where these things are going to be, completely compliant when it comes to corruption. It's not going to be the case. That doesn't mean these assets cannot inflate in prices. And so I think that's really the game we're playing here when we're talking about investing in silver miners.
Looking at it through that lens, I can understand your response to Goldman, right? Goldman sees copper rolling over the next couple of years, likely assuming demand softens or supply responds to higher prices. You disagree. So what structural factor are they underestimating here, Tavi?
I think the demand side is obviously something that often is talking about, but the supply aspect, I think we have enough copper in the world. What we don't have is enough copper above ground.
Yep.
And there's no real, projects coming online anytime soon. And so that issue is going to create a gap here of supply and demand. And I think that the prices, I think it's a very bold prediction to say the prices will fall on the back of the environment that I just mentioned. I don't think we're seeing Dr. Copper, as it used to be in the past, a very good barometer of cyclicality in the world, because the critical needs for copper are much larger than its cyclical nature. And I think that, you should act accordingly and be paying attention to that structural demand factor that I mentioned before, with supply that remains very constrained. And so it's hard to believe prices are, in my view, actually in a potential setup that we could see an explosive move for copper in the next 1 to 2 years that may shock Goldman, but I don't think it will shock me. I'm positioned accordingly.
Yeah. Listen, I want to go back to those big stocks you spoke about a little earlier, right? You're warning that extreme concentration in mega cap US stocks creates fragility. What would be the first clear signal to ordinary investors that this dominance is actually breaking? I mean, not just pausing, and that capital is truly rotating elsewhere.
Yeah, I think that the capital is rotating already, not necessarily from a portfolio positioning. Well, as of recently, sure, but I'm talking about more of a larger rebalancing. We're not seeing that yet.
Right.
I think that the capital itself is already rotating, right? If the free cash flow of these companies have been diminished by the fact that they have been spending more capex, a lot of that capex is rotating into companies that are in the energy space, companies that are in material space, companies that are in infrastructure part of the economy. So all that is rotating already. Well, we're talking about mostly a fundamental rotation, not necessarily a portfolio, a weight rotation into those names as share prices and exposure for investors. But I do think that that's inevitable as we see fundamentals shifting positively relative to the fundamentals of technology companies in particular. I think we're going to see a larger rotation out of this. And again, it's another one of those that goes back to your question about silver miners potentially being structurally different this time. I mean, if we look back in history, 100 plus years of history, of data, and we look into the concentration that we're seeing today, is that normal? No, it's not normal. We've seen a few times in the past, and violently, we've seen a change on the downside where these companies become less relevant, not more relevant, after reaching these extreme levels. I think that sounds somewhat logical, but again, people tend to have their own justifications to say this time will be different and this time will last longer, but it doesn't usually last as long. And so I think that we've seen most of the good results here of these companies, and it's time to focus on where the capital will rotate into, which is, in my view, those three pillars: energy, materials, and also infrastructure.
Yeah. Look, Federal Reserve and just central banks' positions here. I mean, how much does your metals call depend on the Fed being structurally constrained? And what happens to your thesis if the Fed proves it still has room to stay hawkish, Tavi?
I mean, I think it's not so much. It is very dependent, to answer your question. Yes, it's very dependent on my views of what policymakers will do. And I would say to that question that I don't think the fiscal side can afford hawkishness. I think we often get caught up in the conversation about what will inflation do and what will unemployment do. And those developments in the economy will maybe change the course of the Federal Reserve. But I don't believe that that's the case once you reach 4 to 6% of interest payments to GDP. Historically, when you reach these dangerous levels of debt service ratios, you get to a point where basically the relevance of what the Fed thinks becomes irrelevant. And I don't think that what their analysis about the economy really matters outside of allowing the government to afford its own debt. And so this is why we're going to see, in my view, a major suppression of rates. And by the way, if I'm wrong about hawkishness, that's already priced in, right? I mean, the market is pricing 2 cuts of 25 basis points for the next 2 years, right? No recession, nothing, right? Just 2 years of 2 cuts of 25 basis points. I mean, I don't know what people's views are, but I don't think that's going to be the case here. I think we're going to see rates substantially lower. And you may say, well, will they have justification to lower rates? Maybe not. The justification is already the interest payment to GDP. That's all you need to know. And so, I don't know. I have a strong view on this one. I do think that we're going to see the constraint has nothing to do with inflation, nothing to do with labor, has everything to do with the cost of debt at this point.
Yeah. Tavi, just before I let you go, just a quick take on your pattern of movement for gold in the medium term. What do you see happening with the way we view this?
I think that medium term, your guess is as good as mine. And not that I'm trying to, I mean, I think I offer a lot of directional views in markets here, but I think that gold itself has had a big move and it needs some digestion of that move. But I'm not going to try to trade this in the sense of trying to short markets and saying that it's going to fall to a certain level, because we are in a monetary realignment, order right now that I don't think you want to get in front of it. I think you want to own gold. I think you want to own miners, and I think you want to sort of try to write it off this volatility and not try to be too cute trying to figure out how the movement will be created in the next 1-2 years. I do think copper is on the verge of a major breakout. and that's an important directional move. And I think that now we're seeing other derivatives of the gold trade beginning to work. And I think they are still in early stages, emerging markets being one of them, energy being another one. And these trades are still, in my view, early for the year. I think we're going to see a lot more of them.
Tavi Costa, CEO of Azuria Capital. It's been a pleasure. Thanks very much indeed for talking to us.
Thanks for having me.